There are 7 specific mistakes sitting inside how most people claim and manage Social Security, and each one of them can cost thousands of dollars, sometimes tens of thousands, over the course of a retirement, not because anyone did anything reckless, because Social Security is the one government program almost every American touches, and almost nobody is ever taught how it actually works, before the day they have to make a decision about it. Here's the question this video answers. Which of these 7 mistakes are you already making right now, today, without realizing it? And exactly what do you do instead? Starting this week. I'm not just going to name these mistakes. For every single one, I'm going to walk you through a real example with real numbers, and the exact form, question, or phone call that fixes it. Before I go further, I want to say who this is for, because it's genuinely all of you. If you haven't claimed yet, this changes how you should think about your filing date. If you already claimed years ago, several of these mistakes are still fixable today. And if you're married, divorced, or widowed, at least one of these 7 applies to you specifically, in a way that could be worth 6 figures over the rest of your life. And I want to be upfront about something. These 7 are not in a random order. They get more expensive as we go. Stay with me all the way to mistake number 4, because if you're a widow or widower, that one alone has been shown to be worth 6 figures over a 20-year retirement, more than every other mistake on this list combined. If you leave before we get there, you'll miss the single most valuable thing in this entire video. Mistake number 1, claiming at 62 without understanding that the cut is permanent, and without ever running your own break-even math first. Every year you claim before your full retirement age, your benefit drops, and it does not recover later just because you live a long time. If your full retirement age is 67, claiming at 62 locks in a benefit that is permanently 30% lower than what you would have gotten at 67, waiting instead until 70 adds 8% a year for every year past full retirement age, up to 24% more than your full retirement age amount. To put real numbers on it, using the 2026 maximum benefit figures as an example, the same work history that pays $2,969 a month at 62 pays $4,207 at full retirement age, and $5,181 at 70. That is over $2,200 a month difference for the rest of your life, based entirely on when you press submit on the application. Let me walk you through this with a real example. Picture a woman I'll call Margaret. Margaret's full retirement age benefit is $2,000 a month. At 62, she'd get $1,400. At 70, she'd get $2,480. Margaret assumes waiting is obviously smarter because the monthly number is bigger. But that's not actually the right question. The right question is the break-even age, the point where the extra years of smaller checks from claiming early finally get caught by the bigger checks from waiting. For most people claiming at 62 versus 70, that break-even point lands somewhere around age 78 to 80. If Margaret expects to live well past her early 80s, waiting wins by a wide margin. If her health or her family history points toward a shorter retirement, claiming earlier and actually having that money in her 60s can be the better call for her specific life, not a worse one. This does not mean everyone should wait until 70. The mistake isn't claiming early. The mistake is never running this break-even math at all and deciding based on a gut feeling instead of your own numbers. Here's exactly what to do this week. Create your account at ssa.gov if you haven't already, and pull up your own personalized benefit estimate at 62 at your full retirement age and at 70. Then do the simple math for your own situation, factoring in your health and your family's typical lifespan before you file anything. Mistake number 2, assuming that working while collecting early benefits means you lose that money forever. If you claim before your full retirement age and keep working, Social Security applies what's called the earnings test. In 2026, if you'll be under full retirement age for the entire year, you can earn up to $24,480 with no effect at all. Above that, your benefit is reduced by $1 for every $2 you earn over the limit. In the year you actually reach full retirement age, the limit jumps to $65,160 for the months before your birthday, and the reduction is gentler, $1 for every $3 over that amount. Here's an example. Picture a man I'll call Robert. Robert claimed at 63 and took a part-time consulting job that pays him $34,480 a year, exactly $10,000 over the 2026 limit for someone under full retirement age. Social Security will withhold $1 for every $2 of that $10,000 overage, which works out to $5,000 in benefits withheld over the year. Robert sees that letter and assumes the government simply confiscated $5,000 from him for the crime of working. That's the mistake, and it's the part almost nobody tells you. That withheld money is not gone. Once Robert reaches his full retirement age, Social Security recalculates his monthly benefit going forward and gives him credit for every month that was withheld, permanently raising his check from that point on for the rest of his life. A lot of people in Robert's position panic. They quit a job they didn't need to quit, or they avoid claiming altogether, when working might have been the smarter move the whole time. Here's exactly what to do. Before you take a job while collecting early benefits, call Social Security at 1-800-772-1213 and ask this precise question. Based on my expected earnings this year, how much of my benefit will be withheld under the earnings test, and how will that amount be credited back to me once I reach full retirement age? Getting that number in advance means no surprise letter and no unnecessary panic. Mistake number 3. Assuming you can strategically claim only a spousal benefit while your own keeps growing. This used to be possible for a certain generation through a strategy called file and suspend. It no longer is. If you were born on or after January 2nd, 1954, you are subject to what's called deemed filing. The moment you file for either your own retirement benefit or a spousal benefit, Social Security treats you as having filed for both and simply pays you whichever amount is higher. You do not get to pick one and let the other keep climbing. The spousal benefit itself is worth up to 50% of your spouse's full retirement age amount, but only once your spouse has actually started collecting, and it never grows past that 50%, even if your spouse waits until 70. Here's an example. Picture a married couple, Dennis and Patricia. Dennis is the higher earner, with a full retirement age benefit of $2,800. Patricia's own benefit at her full retirement age would only be $900. Patricia assumes she can file early for a spousal benefit now, while letting her own record keep growing for a few more years. The way she remembers her own mother describing decades ago, she calls Social Security expecting to set that up, and finds out deemed filing makes that impossible for her birth year. The moment she files, she's filing for both her own benefit and any spousal amount she's entitled to, and she simply receives whichever is bigger. If Dennis hasn't filed yet, Patricia can't collect a spousal benefit at all until he does. Understanding this before she calls, rather than during the call, changes how Dennis and Patricia should actually coordinate their two filing dates as a couple. Here's exactly what to do. If you're the lower earning spouse, call Social Security or check your online account and ask specifically, has deemed filing already made this decision for me based on my birth year? And what is my actual spousal benefit amount once my spouse files? Know that number before you assume you have a choice you no longer have. And here's the coordination piece most couples never work through together. Because the spousal benefit only exists once the higher earner has filed, and because it's capped at 50% of that spouse's full retirement age amount no matter how long they wait past that point, there is very often no reason left for the higher earner in a couple to delay filing all the way to 70, purely to boost a spousal benefit that already stopped growing years earlier. For Dennis and Patricia, once Dennis reaches his own full retirement age, waiting further only grows his own personal check. It does no favors at all for what Patricia can eventually collect as a spouse. The two of them sitting down together and mapping both of their numbers against both of their filing ages, instead of each guessing separately, is often worth more than either one of them chasing the biggest number on their own account in isolation. Mistake number 4, and this is the one I want every widow and widower watching to sit up for, because it's the most valuable mistake on this entire list to avoid. Here's the exception almost nobody knows about. Deemed filing, the rule I just described, does not apply to survivor benefits. That means if you've lost a spouse, you genuinely can claim your survivor benefit as early as age 60, live on that income, and deliberately let your own personal retirement benefit keep growing with delayed retirement credits all the way to 70. Then switch over to your own larger benefit at that point. 2 completely separate benefits, 2 completely separate timelines, and Social Security lets you sequence them on purpose. Here's an example. Picture a widow I'll call Linda. Linda's survivor benefit, based on her late husband's record, is $1,800 a month at her full retirement age. Her own personal work record, if she waits until 70, would pay her $2,200 a month. Linda doesn't know the switching strategy exists, so she does what most widows do. She compares the two numbers, picks the bigger one, her own record at 70, and simply waits, living on savings or nothing at all in the meantime. That's the mistake. Instead, Linda could claim her survivor benefit now at 60, immediately start receiving $1,800, times whatever the age 60 reduction works out to, live on that income for years, and let her own separate retirement record keep quietly earning 8% a year in delayed credits in the background. Then at 70, she switches to her own, now larger, benefit. She collects income the entire time instead of nothing, and she still ends up at the same maximized personal benefit at the end. Done correctly, this single sequencing decision has been shown to be worth six figures over a 20-year retirement, because she's not choosing one benefit over the other. She's using both in the right order. Here's exactly what to do. If you've lost a spouse, call Social Security and ask this exact question. Can I file for survivor benefits only right now while leaving my own retirement record untouched to keep earning delayed retirement credits until age 70? Say it in exactly those words. Because a generic question like, "What am I owed?" often gets you a generic answer that misses the strategy entirely. Before I go on to the last three, I want to pause on something, because you might be wondering, if this switching strategy is worth six figures, why doesn't the person on the phone at Social Security just walk every widow through it automatically? Here's the honest answer. The Social Security Administration's job is to process the claim you actually submit, not to run every possible combination of strategy for your specific situation and hand you the best one. The representative answering your call is trained to process exactly what you ask for. If you ask for survivor benefits, you get survivor benefits. If you ask what you're owed in general, you'll often just get whichever single number is larger right now, not the sequencing strategy that pays more over 20 years. This isn't a conspiracy. It's simply a system built to answer the question you ask, not the one you didn't know to ask, which is exactly why knowing the right words to say before you dial the phone matters as much as knowing the strategy exists in the first place. Mistake number 5, not paying attention to what triggers taxes on the benefit you already worked for. Social Security uses something called provisional income to decide how much of your benefit is taxable, and the formula is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit for the year. If that total stays under $25,000 filing single or $32,000 filing jointly, none of your benefit is taxed. Cross those numbers, and up to 50% becomes taxable. Cross $34,000 single or $44,000 joint, and up to 85% becomes taxable. Here's the detail that catches people off guard. Those thresholds have not been adjusted for inflation since 1993. Here's an example. Picture a retiree I'll call Arthur. Arthur's Social Security benefit is $24,000 a year. He also has a $10,000 required minimum distribution from an old 401k and $2,000 in interest from a CD. His provisional income comes out to his $10,000 distribution plus $2,000 in interest, plus half of his $24,000, which is $12,000, adding up to $24,000 total. That's under the $25,000 single threshold, so none of his benefit is taxed that year. The next year, his CD renews at a higher rate and pays $4,000 in interest instead of $2,000. That alone pushes his provisional income to $26,000, just over the line, and now up to 50% of his benefit becomes taxable, purely because of a $2,000 shift in interest income he barely noticed. Arthur never connected that CD renewal to his tax bill until his accountant pointed it out. Here's exactly what to do. Before you take a retirement account withdrawal or open a new CD, add up your expected adjusted gross income, tax-exempt interest, and half your Social Security benefit for the year, and check it against these thresholds first. If you're close to a line, ask a tax preparer whether shifting the timing of a withdrawal into a different year could keep you under it. And consider filing Form W-4V with Social Security to have taxes withheld voluntarily, so you're never caught off guard at filing time. Mistake number 6, never actually checking your own earnings record for errors. Your benefit is calculated directly from your recorded earnings history, and the Social Security Administration's own data shows it undercounted or misapplied earnings for a significant number of people, with government estimates putting total underpayments in the billions of dollars in recent years. A missing year, a wrong employer, an old name change that never got linked correctly. Any of these can quietly shrink your monthly benefit for the rest of your life. Widows and divorced spouses are disproportionately affected because their benefit calculation depends on someone else's earnings record being accurate, not just their own. Here's an example. Picture a woman I'll call Susan, who changed her last name when she married in her 20s. 2 years of her early earnings were still filed under her maiden name and never got linked to her current Social Security record. When she finally checked her earnings statement at 68, those 2 blank years were sitting right there in her record, quietly pulling her lifetime average down and shrinking her monthly benefit by around $80 a month, every month, for as long as she lives. Over a 20-year retirement, that is roughly $19,000. She would have simply never noticed. Here's exactly what to do. And it costs nothing and takes about 10 minutes. Create or log into your account at ssa.gov. Pull up your earnings record year by year and compare it against your own old tax returns or pay stubs if you still have them. If you find a gap, correct it with Form SSA 7008, Request for Correction of Earnings Record. If you're divorced, there's a second layer to this worth checking as well. Your divorced spouse benefit is calculated from your ex-spouse's earnings record, not your own, and you generally have no way to see that record yourself the way you can see your own. If something in that record is wrong, you'd have no way of knowing just by looking at your own account. In that situation, the fix isn't to try to check someone else's earnings history yourself. It's to ask Social Security directly when you file, to confirm the benefit calculation in the earnings record it's based on, and to request a written explanation of how your specific number was reached, rather than simply accepting the figure you're given. And mistake number 7, the one that surprises people the most because almost nobody knows it's even an option, assuming that once you file for Social Security, that decision is permanent no matter what. It isn't. But the window is short, and it only works once. If you filed for benefits within the last 12 months and you've changed your mind, maybe you went back to work, maybe you realize now you should have waited, you can file Form SSA 521, Request for Withdrawal of Application, and undo it completely, as if you never filed at all. Here's an example. Picture a man I'll call Harold who claimed at 62 out of pure anxiety after being laid off, then found a new job just 4 months later. Harold realizes he no longer needs the reduced benefit, and that he's now permanently locked into a smaller check for the rest of his life, unless he does something about it. Because he's still inside the 12-month window, Harold files Form SSA 521. He has to repay every dollar he and his family received under that original application, along with anything withheld for Medicare premiums, taxes, or garnishments, but there's no interest charged on any of it. Once approved, it's as though Harold never filed at all, and he's free to let his benefit keep growing towards 70, the way he originally intended. The catch, and the reason this isn't something to use casually, is that Harold only gets this option one time in his entire life. Use it once and it's gone for good. Here's exactly what to do. If you're inside that 12-month window, and you believe the math genuinely works in your favor, request Form SSA 521 directly from Social Security. Confirm in writing exactly how much you'd need to repay before you commit. And remember, this is a once-in-a-lifetime option, not something to use lightly. Now, here's something I want to leave you with beyond just the list, because knowing 7 mistakes exist and knowing what order to actually act on them in are 2 different things. So let me give you a simple way to sequence this, based on where you actually are right now. If you haven't filed for Social Security yet at all, your very first move is mistake number 1. Pull your own estimate at 62, at full retirement age, and at 70, and do the break-even math before anything else, because every other decision downstream depends on that filing date. If you're planning to keep working after you file early, layer mistake number 2 on top of that same conversation, so you know your real earnings limit before you take a job that could trigger withholding you weren't expecting. If you're married and haven't filed yet, mistake number 3 is your next stop, sitting down with your spouse and mapping both of your numbers together, not separately, before either of you submits anything. If you've lost a spouse, stop everything else on this list and go straight to mistake number 4 first. That's the one worth more than all the others combined. And it's also the one with the least room for delay, because every month you wait to even ask, the question is a month of income you can't get back. If you're already collecting whether you got everything else right or not, mistakes 5, 6, and 7 are your maintenance checklist. The things worth checking once a year for the rest of your life. Check your provisional income before you take any withdrawal or open any account that pays interest. Check your earnings record once, and then again anytime you notice your benefit looks lower than you expected. And if you filed within the last 12 months and immediately regretted it, remember the SSA 521 window closes fast. So that one can't wait for someday. So, here's all 7, one more time, in one place, claiming at 62 without running your own break-even math first. Assuming working while collecting means that withheld money is gone forever. Assuming you can claim only a spousal benefit while your own keeps growing. Missing the survivor benefit switch strategy if you've lost a spouse. Not watching the provisional income thresholds that decide how much of your benefit gets taxed. Never checking your own earnings record for errors, and assuming your filing decision can never be undone within that first 12 months. None of these mistakes happen because anyone did something wrong. They happen because this system was never explained clearly to the people who depend on it most. The people who avoid these 7 mistakes aren't luckier or wealthier than everyone else. They simply found out the rules and the exact form or phone call that fixes each one, before it cost them instead of after. If you know someone approaching Social Security or already collecting it, who's never heard even one of these 7, send them this video today. It might be the difference between the number on their check for the rest of their life and the number it should have been. And if this video helped you, hit that subscribe button and turn on notifications. I put out new videos every week on the things nobody tells you about money and retirement. I'll see you in the next one. This video is for educational purposes only and does not constitute legal, tax, or financial advice. Social Security rules can vary based on your individual work history and marital situation. Confirm your own numbers directly with the Social Security Administration before making a filing decision.